Hello everyone and welcome back to the discussion on mock test paper number 2. Now this video, of course, you should watch only if you have solved this test paper 2, and if you haven't done it, please first download the paper and solve it. As far as the question paper is concerned, I am giving you instruction. You can just download the question paper by the link given in the description. So just click the link, follow the procedure and download the question paper, solve it, and then you may come back to this video. However, if you are watching this video after solving the test paper already, just to verify whether you have gone correct or not, you are definitely doing the rightful thing. And as earlier, I am not going to give you too much time to write down the solutions. What you can do, every time I display the content of a solution, I'll just give a pause for around 4 to 5 seconds for you to take screenshot, and then we may proceed ahead, or alternatively you may pause the video and write up the solution if any way you want to write it. So let us begin with our discussion over here, and we begin with the first question, that is titled as question 1A. Now this particular question has been picked up as question number 41 from the textbook, that is from the derivatives futures part. Question 41. Nitrogen Limited, a UK company, is in the process of negotiating an order amounting to euro 4 million with a large German retailer on 6 months credit. If successful, this will be the first time that Nitrogen Limited has exported goods into highly competitive German market. The following 3 alternatives are being considered for managing the transaction risk before the order is finalized. First, invoice the German firm in sterling using the current exchange rate to calculate the invoice amount. Second is the alternative of invoicing the German firm in euro and using a forward foreign exchange contract to hedge the transaction risk. Third, invoice the German first in euro and use sufficient 6-month sterling future contracts to the nearly whole number to hedge the transaction risk. Further given, following data is available. Spot rate, they have given the rate of pound in terms of euro. 6-month forward points have been given in terms of euro cents, and then you have been given 6-month future contract is currently trading at euro 1.1760 per pound. 6-month future contract size is pound 62,500. 6-month spot rate and future settlement rate is given as euro 1.1785 per pound. Required, calculate to the nearest pound the receipt for Nitrogen Limited under each of the 3 proposals. And second thing they are asking, in your opinion, which alternative would you consider to be most appropriate and the reason therefore. So friends, before we proceed with the solution, let us first analyze the entire question. Let us go back to the first part of the question. Let us see what is informed to us. First of all, the company Nitrogen Limited is an exporter based in UK, correct? So it is clear that this is an exporter operating in UK. That means its local currency is sterling or GBP or simply pound. Now the customer's currency in Germany is in euro and invoice value is euro 4 million. However, there are 3 alternatives given for hedging the foreign exchange risk from the viewpoint of this UK company. So the first is invoicing in sterling. Invoicing in sterling means as good as invoicing in local currency. If you are invoicing in local currency, obviously foreign exchange fluctuation risk does not fall upon you. Second, it is the alternative of invoicing the German firm in euro and then hedging through the forward contract. And third is to use the currency futures to hedge the risk. So finally what we are going to do is we are going to evaluate the three alternatives given to us, and we will work out the amount of inflow in GBP or in sterling. And because it is a case of inflow, we will look into the inflow which gives the maximum value, whether it is alternative 1, 2 or 3, whichever gives maximum inflow in terms of GBP will be the alternative selected. Now let us move forward with the information given. Spot rate is given as Euro 1.1750 to Euro 1.1770 per pound. That means the quote is given for pound in terms of euro. No doubts about that. Further, 6-month forward points given. It is 0.60 to 0.55 euro cents. First of all, friends, you should understand 1 euro cent would be euro 0.01. So if I write 0.60 euro cents, it will be basically the last two digits in terms of points, right? So instead of informing 60 points as forward points, they have given 0.60 and quoted as euro cents. While we write the solution, we would simply consider this as 60 points and 55 points to be adjusted at the last two digits of the given quote, the way we have always been dealing with swap points. Now, if you observe the points, the point applicable for bid rate is higher than the point applicable for ask rate, which is a clear indication that the quoted currency is depreciating. Quoted currency over here is pound. So pound is depreciating against euro. That is a clear hint. Therefore, to arrive at the forward rate from the spot rate, you are going to subtract these forward points. Then there is information given about the currency future, and currency future contract is given in pounds. So when you are exploring this alternative of currency future, understand one thing very well. Your receipt will be in euro, correct? Because the invoice value is euro 4 million, your receipt will be in euro. Your objective will be to sell euro, but the currency future contract is given in terms of pound. So indirectly you would want to buy pounds, correct? And because you would want to buy pounds, you should take a long position in the currency futures contract. And now they have given this as the settlement rate for the futures contract, and the same thing has been informed as 6-month spot rate also. So now let us see how to present the solution. In the solution, you would first mention that Nitrogen Limited is an exporter. So the best outcome would be the one which can maximize the inflow. So alternative 1 is to invoice in sterling using the current exchange rate. So invoice value has been given as euro 4 million, that is euro 40 lakhs. And now because you would want to sell euro, but the quote is given for pound, so you will have to take the inverse values. So euro 1 will be pound 1 upon 1.1770. You should understand one thing, it is a case of two-way quote. And look into one thing, we wanted spot bid rate, we have taken inverse of spot ask rate, correct? Because inverse of ask rate will become bid rate. So this was given as ask rate of pound, we wanted bid rate of euro, we have taken the inverse of ask rate to obtain as bid rate of euro. So obviously what you will do now is the invoice value in terms of pound will be 40 lakh euros divided by 1.1770, and that will give you pound 33 lakh 98,471. We have marked this as 1, that is, this is the final amount of inflow under alternative 1. So do one thing, friends, take note of this part of the solution and then we shall move ahead. Alright friends, you would have finished writing these calculations. Let us move ahead and deal with the second alternative. The second alternative talks about the use of forward exchange contract. So first of all, the invoice value is euro 4 million, or you can say euro 40 lakhs. Spot rate is given in terms of pound, right? So pound 1 equals to euro 1.1750 to euro 1.1770. 6-month forward points are given as 60 by 55. Basically, if you recall, the question has given you the information about these forward points in terms of 0.60 and 0.55 in terms of euro cents. And I told you 1 euro cent is 0.01 euro, correct? That means if it is 0.60 euro cent, it will be basically 0.0060 euro. Therefore, we have taken these as 60 by 55 simply in terms of points. And I told you earlier, because the point applicable for bid rate is higher than the point applicable for the spot rate, it indicates that the quoted currency, that is pound, is depreciating. That means you are going to subtract these points from the spot rate to arrive at the 6-month forward rate applicable. However, we don't want both the rates, correct? We want to ultimately sell euros. In other words, we would want to buy pounds. So for buying pound, the pound ask rate will apply. That means inverse of this ask rate we would consider as the bid rate for euro. So finally we would say 6-month forward rate applicable will be 1.1770 minus 55 points. So we have written 55 points as 0.0055. Understand one thing, this is a euro value, and in the question what was given as euro cent 0.55. Euro cent 0.55 is as good as euro 0.0055. And finally what you get as the applicable rate, euro 1.1715 per pound. So finally 6-month forward rate applied, it will give you resulting inflow of euro 40 lakhs divided by that rate, and the final value what you get in terms of pound will be 34 lakh 14,426 pounds. So friends, take note of this part of the solution as well, and then we shall move ahead. Alright friends, you would have finished writing this whole thing. Let us move ahead and take up the third and last alternative, that is using currency futures. Now because the contract is given in terms of pounds and you are a UK exporter, you will have to sell euros. In other words, you will have to buy pounds. The currency future contract is given in pounds. Obviously, you are going to take a long position in such contract. That is why we have specifically mentioned long position in such currency futures contract, and the contracted rate is euro 1.1760 per pound. When you convert 40 lakh euros in pounds using this rate, you get 34 lakh 1,361 pounds, and contract size is 62,500 pounds. So you may find the number of contracts, it is 54.42, because the question has emphasized, and anyway we cannot take contracts in fractions, we have rounded off that number of contracts to 54 contracts. So write down this whole calculation and then we shall move ahead. Alright friends, you would have finished writing these calculations up to total number of contracts as 54 contracts. Let us move ahead and work out the gain or loss arising on currency futures. So in case of currency futures, the contracted price to buy, don't forget you took a long position in the currency futures contract. So the contracted price to buy was euro 1.1760 per pound, and price adopted for settlement of future is euro 1.1785 per pound, and the gain what you get will be euro 0.0025 per pound. Contract size is 62,500 pounds and you have taken 54 contracts. So total gain will be in euro 8438, that is euros 8,438. So note down these calculations and then we shall move ahead. Alright friends, after noting down the total gain amount as euro 8,438, let us move ahead and calculate the total inflow under currency futures. So don't forget that you will have a receipt of euro 4 million, and along with that receipt of euro 4 million, you are going to simply add your gain from currency futures. That means after 6 months you will receive euro 4 millions or 40 lakh euros, and your gain on currency futures was 8,438 euros. So finally what you get in hand after 6 months will be euro 40 lakh 8,438, correct? Now this you are going to convert in pounds by using the spot rate that would prevail after 6 months. So this is same rate which was used as a settlement rate. Question has given you one common rate. Finally, applying this rate, the value that can be converted in terms of GBP will be pound 34,01,305. All these figures identified as 1, 2 and 3 alternative final conclusions are the amounts of inflows, and we find that the maximum inflow was in the alternative of forward exchange contract. So we would conclude inflows can be maximized using forward exchange contract to hedge transaction risk. So friends, take note of this also, and that will be end of the solution. Alright friends, once you have completed this, let us move ahead and take up the next question. That will be question 1b. Now this question, as per the textbook, it is question number 19, again from the derivatives futures part, and let us read this question. On April 1, 2015, an investor has a portfolio consisting of 8 securities as shown below. So if you notice, you have been given details about 8 securities A, B, C, D, E, F, G, H, and the details are available in respect of market price, number of shares and beta. Now further they inform that the cost of capital for the investor is 20% per annum continuously compounded. The investor fears a fall in the price of the shares in the near future. Accordingly, he approaches you for the advice to protect the interest of his portfolio. You can make use of the following information. The current Nifty value is 8,500. Nifty futures can be traded in units of 25 only. Futures for May are currently quoted at 8,700 and futures for June are being quoted at 8,850. And now what is required? You are required to calculate the beta of his portfolio, the theoretical value of the futures contract for contracts expiring in May and June, and you have been given some table values of e raised to 0.03, e raised to 0.04 and e raised to 0.05. The number of Nifty contracts that he would have to sell if he desires to hedge until June in each of the following cases. Now what he desires to hedge: in the first case his total portfolio, in the second case 50% of his portfolio, and in the third case 120% of his portfolio. So friends, basically if you look into this is a little bigger question, but if you just follow the steps that you have learned in hedging through index futures, you are easily going to solve this. So let us begin solving this question. In fact, the first thing what we should do is we should work out the weights, and along with the calculation of weights we will also calculate the beta of the portfolio. So what we do is security, market price, number of shares, value, beta and weighted beta. You should know one thing, that the beta of the portfolio is the weighted average of betas of individual securities, correct? Now we are plotting a table where we are considering the security and market price and number of shares have been informed. Obviously when you multiply the market price of each share with the number of shares, you will get to know the amount invested in that stock, and the proportion of money invested will become the weights for determining the weighted average beta, which will be the beta of the portfolio. So what we have done, the value column has been identified as C and beta column as D, and C into D will be giving you the weights multiplied on beta when you get that total value, and that total when you divide by the overall value, you will be getting the beta of portfolio, which actually indicates the weighted average betas of individual stocks. So now let us do one thing. Let us start with stock A. So stock A, the price is 29.40 and the number of shares held are 400 shares. So when you multiply 400 shares with the price per share, that is 29.40, you will be getting the total amount invested by the investor on stock A, and beta of stock A is 0.59. So what we do is we multiply this weight in terms of value to this beta to get the weighted beta, and the aggregate of this, as I told you, will be used for determining the beta of portfolio. And in the same way, we would write up the calculations for each of the 8 stocks. So friends, what you can do is you can start making this table quickly, and once you have made all the calculations, don't forget to add up the value column and the weighted beta column, and then we will make all the other calculations ahead. So time for you to note down all the calculations. I am giving you sufficient time. Take note of all these and then we shall move ahead. Alright friends, you would have finished writing all these calculations. So let us move ahead and now finally compute the portfolio beta. The numerator over here we have taken as the weighted beta column total, and this is the total amount invested. And simply when you divide this by this, what you get is the weighted average beta. Now you could have otherwise computed weights on individual basis by taking the proportion of money invested and then applied those weights, but that would have been little longer way of determining beta, but would have still given you the same result. Now the question in the second part is asking you to find the theoretical value of futures contract, which we generally call as FFP, that is fair futures price, and for the contracts expiring in May and June. And how do you compute FFP? You would find when the index does not yield any returns, you simply find FFP by taking S0 into e raised to RT. So let us define these variables. FFP stands for fair futures price. S0 is the current market price or the spot price of Nifty, which is given as 8,500, and R is the rate of interest. T is the time remaining for maturity. For May it is 2 months time remaining, and for June it is 3 months time remaining. So friends, quickly take note of these calculations and then we shall move ahead. Alright friends, you would have finished writing all this. Let us move ahead and take up the other calculations. So first of all, we find FFP for May. Very simple task. It is spot price into e raised to RT. So let us try to understand one thing. 8,500 is given as the spot price, so no problem in applying that. E raised to RT, R is 20%, that is 0.2, and time remaining for maturity for May contract will be 2 months, but time what we write over here should not be in number of months, it has to be in number of years, so it will be 2 by 12. When you apply 0.2 into 2 by 12, what you get is 0.03333. Now the value of e raised to RT, it is coming between 0.03 and between 0.04. So it is between e raised to 0.03 and e raised to 0.04. Now the value we don't have for this part actually. So what you can actually do is you may use statistical interpolation. The way you have learnt interpolation, you may use that and arrive at this factor. So this is the factor for e raised to 0.03333. And how we have obtained this? We have obtained by taking interpolation of the values given for e raised to 0.03 and e raised to 0.04. And finally, the May contract has theoretical value as 8787.90. Now, for computing the same thing for June, when you take e raised to RT for June, in June it is 3 months time remaining for maturity. So it will be e raised to RT as in 0.2 into 3 by 12, which will give you 0.05, and e raised to 0.05 value is directly given to you. So you may apply that and determine the theoretical price for June contract. So friends, quickly take note of all these calculations and then we shall move ahead. Alright friends, you would have finished writing all these calculations. Let us move ahead and take up the other calculations. So next thing what the question has asked is the number of Nifty contracts that this investor would have to sell if he wants to hedge till June. And there are different cases given. So one thing, we would first determine the value of stock portfolio. For this purpose, the value of stock portfolio is 9,94,450. This is nothing but the total money invested, right? In the very first working note made via that initial table, we have shown this. Second thing is we have to determine the beta of the portfolio. If you remember, beta of portfolio was the follow-up calculation again. Thereafter, determine the desired value of the Nifty futures portfolio that you would want to hedge. So, and you know one thing, that how to make this. The desired value of Nifty futures portfolio can be obtained by multiplying the beta to the value of stock portfolio, and that product what we are getting is 10,95,884. In the first part of the question, they are asking that he wants to hedge his entire portfolio. So how many contracts he should sell? That means he should take a short position with as many contracts that will match up with this value. And in the later parts, they have asked to hedge 50% and 120% of the portfolio. So we will definitely write up those calculations, but first what you do is write up what you find on screen and then we shall move ahead. Alright friends, you would have finished writing all these calculations. So let us move ahead and then we work out the contract size. The contract size is given to you as 25 Nifties, and for the June, the price which is given is 8850. So value of one futures contract will be 8850 into 25, and that will be rupees 2,21,250. Now, how many contracts you have to cover up with a short position? You can simply determine by taking the desired value of Nifty futures divided by the index futures price and multiplied by the hedge ratio. Whether you want to fully cover it through hedge, that is 100% or 50% or 120%, that can be decided over here. So do one thing, write up these calculations also and then we shall move ahead. Alright friends, let us move ahead and make up the last part of the calculation. So first thing, if he wants to hedge his total portfolio, that is a perfect hedge is being planned. So you would simply apply the hedge ratio as 100%, for which 4.935 contracts required. Obviously, it is not possible to have fractional contracts, so you may round it off to 5 contracts. So over here, you would agree that there will be a slight over hedging, correct? Whatever was required, you have hedged more than that. And second part of the question is asking you to cover 50% of the portfolio, and 50% of a portfolio would obviously be resulting into under hedging, where it is 2.477 contracts, but we have no choice but to round it off to 3 contracts. And last part, 120% of his total portfolio, which will be obviously resulting into over hedging. Here you need 5.944 contracts rounded off to 6 contracts. So friends, this will be your final answer to the last part of the question. So take note of all these calculations and that will be end of the solution.
Alright friends, once you have completed this particular solution, let us move ahead and take up the next question, that will be question number 1C. Let us observe that this will be question number 36 from the derivatives futures part, which happens to be the segment of commodity derivatives. Question number 36, let us deal with this. A rice trader has planned to sell 22,000 kgs of rice after 3 months from now. The spot price of rice is rupees 60 per kg and 3 months futures on the same is trading at rupees 59 per kg. Size of the contract is 1000 kgs. The price is expected to fall as low as rupees 56 per kg 3 months hence. Required to interpret the position of trader in the cash market, to advise the trader whether he should take position in futures market to mitigate his risk of reduced profit, and third thing, to demonstrate effective realized price for sale if he decides to make use of futures market and after 3 months the spot price is 57 per kg and futures contract price for closing the contract is rupees 58 per kg. Now could you see one thing, this is exactly like that example that you did a few minutes back, but with one difference. This third point in the question has made something different over here. Fact number 1, the price was expected to fall to 56 per kg, but the actual price after 3 months in the spot market was 57 per kg. Now generally we would have taken 57 per kg as the settlement price of this commodity futures contract as well, but because this price for settlement has been separately informed, you are going to consider this price and not 57. So how will you make the calculations? You have agreed to sell the quantity of rice as per commodity futures at 59 because you will take short position in the commodity futures, but the price at which the commodity futures contract got settled was rupees 58 per kg. So at 59 you have agreed to sell and the settlement price is 58. Difference between 59 and 58 will be a gain of rupee 1 per kg. For the total quantity of 22,000 kgs, it will be a total gain of rupees 22,000. That will be added to the realized value on sale of rice, which realized rupees 57 per kg in the spot market. So the total realization effectively will be 22,000 kgs into 57 in the spot market, and the gain from commodity futures will be 22,000 kg into rupee 1 per kg, and that will be rupees 22,000. Both taken together will be the total realization. That divided by 22,000 kgs will give you realization per kg on effective basis. So let me just help you in terms of how to present the solution over here. Since the trader has planned to sell after 3 months, it implies he is in long position in cash or spot market. Since the trader is in long position in spot market, he can mitigate his risk of reduced profit by hedging his position by selling rice futures, that is short position in futures market at 3 months futures price of rupees 59 per kg. Number of contracts with short position, it should be computed by taking the total quantity of rice held divided by the quantity of rice per contract. That will be 22,000 kgs divided by 1000 kgs per contract, and that will give you number of contracts as 22 contracts. So please write up this part of the solution and then I take you ahead. Alright friends, once you have completed writing this part of the solution, let us move ahead and deal with the next part. So after 3 months, the gain in the futures market will be rupees 22,000. I have already explained this to you. Effective realized price will be the price realized on sale of 22,000 kgs in the spot market at rupees 57 per kg. That will give you rupees 12,54,000 and rupees 22,000 as gain from commodity futures. The total cash flow or the total realization will be 12,76,000. That amount when divided by 22,000 kgs, it will give you effective selling price of rupees 58 per kg. So please write up this whole thing and that will be end of the solution. Alright friends, after completing this particular solution, let us move ahead and take up the next question, that will be question number 2A. As per the textbook, this is question number 31 from the derivative second part, that is from the options. Let us deal with this question.
Current market price of HP Limited is rupees 4,800. At end of each quarter, there is 40% probability that price will increase by rupees 60 and 60% probability that price will decrease by rupees 20. A 6-month call option is available on this share with exercise price of rupees 4830. Continuously compounded risk-free interest rate is 12% per annum. Determine the present value of this call option. So friends, what we have as part of the information, the whole question is very similar to what we have seen earlier, but now look into the last line. They have mentioned the interest rate involved over here, and that is with continuous compounding. So what we are going to do, we are going to simply add one more feature to this concept, that is we will be bringing in the concept of time value of money. We will incorporate the time value of money along with our calculation, and how to do that as an additional step, we will plan it very well. So what we have to do, it is current market price and the period is 6 months as a expiry period for this call option. Now the probabilities that are given are at end of each quarter, not each month. Okay, so it's overall 6 months time, and it will be split into quarterly periods, and there will be 2 quarters in this whole span of 6 months. So this is a 2-period model what we have to apply over here. So friends, initially how you draw the tree of outcome will be exactly in the same way. Only thing is, at the end we are going to find the present values using continuous compounding in this given question. So how to present the answer? Let us move ahead and see that. So same thing, you begin with the current market price of 4,800. There is a 40% probability that at end of first quarter, the price will increase by rupees 60. So 4,800, 4,860, 40% probability. 60% probability that the price will fall by rupees 20. 4,800 minus 20 makes it 4,780. Now these two are the probable prices that we are expecting to prevail after a quarter, that is after a period of 3 months. And from each of these points, there is a further chance of rise and fall in price in the same way. So it is 40% chance that the price will rise by 60. So 4860 plus 60 makes it 4920, and from here there is a 60% probability of decline in price by rupees 20. So 4860 minus 20 makes it 4840. Likewise, from this node also there will be 40% probability of increase in price by rupees 60. So 4780 plus 60 makes it 4840, and 60% chance of price falling by rupees 20. So 4780 minus 20 makes it 4760. Now this is given as a case of call option, and what is the condition for exercising call option? With respect to call option, we simply follow one condition, that call option will be exercised when expected market price is higher than the strike price. In this case, the strike price is given to you as 4830 and the expected market price at this node is 4920. So obviously we have a perfect condition for exercising of a call option. So the value of the option will be market price minus exercise price, that will be 4920 minus 4830, rupees 90 is the value of option over here. So I am simply writing this 90 with this node. Okay. Now over here again the price which we are expecting to prevail is 4840 and strike price is 4830. Again the call option will be exercised with a value of rupees 10, which we are identifying with this node. again 4840. So same thing, exercise, and the value of this option will be rupees 10. Now at this node, the strike price being 4830, expected market price is now lower. So with a lower expected market price, obviously your call option will not be exercised. We will let it lapse, and the moment any option is lapsed, its value will be 0. So 0 is assigned to this node. So we finally got 4 different values of options, or I would say 4 probable values of options by end of 6 months. From here we will drag the values to end of 3 months, and finally over here exact same approach with just a little difference, and that difference I have not yet incorporated. Before I take you ahead, please note down this much first. Alright friends, you would have finished writing this whole thing. Let us move ahead and look into one new aspect over here. How would you incorporate the interest element? So first of all, what I am doing is these workings where we have found these option values, I am removing this. You would have already written. Now what we do, we have 90 and 10 as 2 probable values with their respective probabilities as 40% and 60%. So the value of option in this node would be 90 into 40% plus 10 into 60%. Whatever value you get, that will be the probable value with respect to this node, but that probable value is appearing at end of 6th month. We want its value at end of 3 months. That means from 6 month end to 3 month end, the time lag of 3 months, you will have to apply the interest element. That means you will have to basically find the present value of that probable value. So first you do one thing, you find the probable value as 90 into 40% plus 10 into 60%. That probable value is at end of 6th month. You drag it to end of 3rd month by taking its present value, and that requires application of continuous compounding as per the instruction given in the question. So what we do now is we take 90 into 40% plus 10 into 60%. In the numerator, you will be getting the probable value of option by end of 6 months. Now 3 months of discounting, correct? So e raised to RT, e raised to R, rate of interest is 12%, 0.12, time is 3 months, so 3 by 12. So finally what we get over here is 90 into 40% will be 36, 10 into 60% will be 6. So finally 36 plus 6 divided by e raised to 0.12 into 3 by 12 will make it 0.03. So finally what we do is 36 plus 6 is the probable value of option, that is 42, and e raised to 0.03, you can refer it from the table and arrive at 1.03045. So basically the probable value of option is 42, but its value as 42 is at end of 6th month. We want to arrive at the value at this node which is at end of 3rd month. Therefore the present value of this 42 will be 42 divided by 1.03045, and that is 40.76. So 40.76 recorded over here. In earlier questions, we were not applying this component of time value of money. This question, this is one added feature, that's all. So same thing we do over here. 10 and 0 are the 2 probable values with their respective probabilities as 60 and 40%. So probable value of option will be 40% of rupees 10 and 60% of rupees 0 added. This will be the probable value of option divided by e raised to RT to arrive at the present value. So 4 plus 0 divided by e raised to 0.03. So that is 4 divided by 1.03045, and that gives you 3.88. 3.88 will be the value of option over here. So friends, do you notice one thing, that this time value of money calculation what we are putting in, this is requiring some additional workings to be made. So what I do is I give you time to first write down all these workings and the values of options till this stage, that is end of 1st month. These 2 values, write up this all and then we proceed ahead. Alright friends, you would have finished writing this whole thing. So what we do is, taking the matter ahead, because you would have written these workings already, I am removing these workings from here, and what we do now is, we consider these two probable values of options by end of first quarter, that is end of 3 months, and we have probabilities of these two option values as 40% and 60%. So exactly same way as we did earlier, 40.76 into 40% and 3.88 into 60% will be the probable value of option over here. The present value of that will be the value of option at present. So it will be 40.76 and 3.88 as probable values, and 40% and 60% are the respective probabilities. 40.76 into 40% and 3.88 into 60% divided by e raised to RT will directly give you the present value of the option. So the probable value of option will be 18.632, the numerator part, and the present value of that, when you have to find, divided by 1.03045, and what you get is 18.08. So conclusion is, the present value of this option, that is the call option, is 18.08. So friends, write up this also, and that will be end of the solution.
Alright friends, once you have completed this particular solution, let us move ahead and take up the next one, that will be question 2b. And as per your textbook, this question is question number 28, again from the derivatives options part, which happens to be a question on option valuation. Let us deal with this.
Present market price of the share is given as rupees 64. 1 year call option is available at an exercise price of rupees 80. The risk-free interest rate is 9% per annum. Probable price after 1 year. So we have two different probable prices. The lower one is 48 and the higher one is 128 as represented by MP1 and MP2. Determine the value of call option in today's terms by using risk neutral model and binomial model. Also determine the value of put option at the same exercise price using put call parity theory. So friends, in this question we have to first apply risk neutral model and then binomial model to determine the value of call option, and then using put call parity theory we have to derive the value of put option for the same exercise price. So as such, nothing new, no new concept, it is just practicing what we have learned earlier. So let us see how to present the solution. So in the solution, we first write value of call option in today's terms using risk neutral model. For that, maturity value of RFI is LPP into probability of fall in price. LPP stands for lower probable price, plus HPP into probability of rise in price. HPP stands for higher probable price. So let X be the probability of rise in price, and 1 minus X will be obviously the probability of fall in price. So let us substitute all what we have in that equation. So 64 into 1.09, the current market price of the share is 64. So instead of investing in the stock market, if we invest 64 at risk free rate of 9%, its maturity value will be 64 into 1.09. On the other side, when you invest in stock market, the two probable values at the year end for the share could be either 48 or 128. So 48 will be multiplied to the probability of fall in price, 128 will be multiplied to the probability of rise in price. And finally what we have, when you solve this, 69.76 as the maturity value of RFI, 48 into 1 remains 48, 48 into minus X becomes minus 48X, and 128 into X is plus 128X. When you solve this, what you get is 69.76 equals to 48 plus 80x, that is 128x minus 48x. Finally, what we have is 80x equals to 21.76, x equals to 0.272. So the probability of rise in price, what we have is 0.272, and probability of fall in price will be 1 minus x, that is will be 0.728. So friends, please take note of this and then we move ahead. Alright friends, let us move ahead. Value of call option by maturity. In case of higher probable price, the option will be exercised. Being a call option, its value will be market price minus exercise price, that will be rupees 48. In case of lower probable price, it is not a good condition to exercise the call option. It gets lapsed and its value will be 0. Now, in order to find the probable value of option by maturity, what you need to do, 48 is the value of option when the price goes up, which has a probability of 0.272, and 0 will be the value of option when the price goes down, which has a probability of 0.728. So what we do is, probable value of option by maturity will be 48 into 0.272 plus 0 into 0.728. So value of call option on maturity will be 13.056, and present value of option will be 13.056 divided by 1.09, and that comes to 11.98. So note down this much and then we move ahead with binomial model. Alright friends, you would have finished writing this. So let us move ahead and deal with the binomial model. So in binomial model, what you have to do, write up this formula. I have already explained you what is this all about. I don't have to explain you again. Okay. Define all the variables. CU is 48. Why CU is 48? I have discussed already earlier while dealing with the risk neutral model. And now CD is again 0. That also you know. Value of call option when the price goes down, 0, because it is getting lapsed. I will be 1 plus risk free interest rate, that is 1.09. U will be HPP upon S0, and that comes to 128 by 64, that is 2. And D will be LPP upon S0, that comes to 48 by 64, and that is 0.75. So what you do friends, write up the formula, write up the definition of these variables, and then we substitute these values and make the calculation ahead. First note this much down. Alright friends, you would have finished writing this whole thing. Let us move ahead and substitute these values in the formula. So what we have is 48 into 1.09 minus 0.75 divided by 2 minus 0.75 plus 0 into 2 minus 1.09 divided by 2 minus 0.75 whole upon 1.09. Most important thing is this part where the value of call option when the price goes up is multiplied to I minus D upon U minus D, which is the probability of rise in price, and this part is the probability of fall in price, which is getting multiplied to 0. This whole term will become 0 ahead. Now what we get in calculations, 48 into 0.272. Don't forget that 0.272 we already got as probability of rise in price, and finally what we get is 11.98. So note down this as well and then we move ahead. Alright friends, let us move ahead. Time for us to apply put call parity theory and determine the value of put option. So we know what is this put call parity theory. I don't have to explain you again and again, and we get 11.98 plus 80 divided by 1.09 minus 64, and when you solve this, what you get is rupees 21.37, which indicates the value of put option for the same exercise price. Note down this as well, and that will be end of the solution.
Alright friends, once you have completed this solution, let us move ahead and take up the next question, that will be question 2C, and this happens to be question number 10 from your textbook, which is picked up from the derivative options part. Question number 10, let us deal with this.
Mr. X established the following spread on the Delta Corporation's stock. Purchased one 3-month call option with a premium of rupees 30 at an exercise price of rupees 550. Purchased one 3-month put option with a premium of rupees 5 at an exercise price of rupees 450. Delta Corporation's stock is currently selling at rupees 500. Determine profit or loss if the price of Delta Corporation's remains at rupees 500 after 3 months, falls at rupees 350 after 3 months, and rises to rupees 600. Assume the option size is 100 shares of Delta Corporation. So it is clear that in this strategy, the investor Mr. X has simply gone long with call as well as put option and has paid premium over 100 shares of Delta Corporation on call as well as put option. Now we need to work out the profit or loss under all these three different situations. First scenario is if the price remains rupees 500 what it is now even after 3 months. What if it falls to 350 and what if it rises to 600? Let us see outcome of all these scenarios and let us also see how to present the solution. In the solution, we would first write up the total amount of premium paid by this investor Mr. X. So call option premium is rupees 30 per share and option size is 100 shares. So 100 shares multiplied by rupees 30 would obviously give you rupees 3000 as a total premium for holding call option, and similarly for holding put option the premium will be 100 into rupees 5 per share, that will be rupees 500. In simple words, the total premium expenses incurred by Mr. X will be rupees 3500. Quickly take note of this and then we shall move ahead. Alright friends, after writing this, let us move to compute the profit or loss in each of the three scenarios. Beginning with the first scenario, that is if the price of the stock stays at rupees 500 after 3 months, what happens to call option? Look into one thing, the market price, what we call as MP, is 500, correct? Because after 3 months, the price will stay rupees 500, says the question. So market price will be 500 and exercise price is 550. Check one thing, the call option is being held with a strike price or exercise price of 550. Now compare these two. You know one thing very well, that call options are exercisable only when market price is greater than exercise price. Look into one thing, here market price is less than exercise price, so you are not going to exercise your call option. So you would conclude that because market price is less than exercise price, call option will lapse and payoff will be 0. Now let us see what happens to put option. Market price remains same 500. Exercise price of put option, what we find in the question, is 450. So boss, look into one thing, the condition for exercising put option is market price should be less than exercise price. This is what we have been learning throughout in option basics, right? And we find that the condition is not worth exercising a put option over here. So put option will be exercised only when market price is less than exercise price. In this case, market price is greater than exercise price. So we would conclude because market price is greater than exercise price, put option will also lapse and its payoff will be 0. So both the options got lapsed. So nothing you got out of the two options as an outcome at the end. Finally, what happens? The total amount of premium that you have paid will be your loss. So we would write net loss is the total amount of premium that you have paid, and that is rupees 3500. So friends, take note of all these calculations and then we move to the next scenario. Alright friends, let us move to the next scenario, where if the price of stock falls to rupees 350 after 3 months, let us see what happens to call option. Market price is 350, exercise price is 550. Again, call options are exercisable only when market price is greater than exercise price. But what do we find over here? Market price is still less than exercise price. So obviously not a good scenario for exercising a call option. Call option in this case goes out of the money and therefore it will get lapsed. It will not be exercised. So you would write market price less than exercise price, therefore call option will lapse and payoff will be 0. What happens to put option over here? Market price, as we said, it is 350 and exercise price is 450. Now what we have learnt, put option is exercised only when market price is less than exercise price. What do we find in this scenario? Market price is definitely less than exercise price. That means a fantastic scenario for exercising the put option. Put option is found over here in the money and therefore it will be exercised. So if it is exercised, let us find the payoff. So what do? Payoff for each share in this put option will be strike price minus market price or exercise price minus market price. This is what you have learned, right? Payoff for any put option or intrinsic value of a put option is EP minus MP, that is exercise price minus market price, and that is rupees 100. What happens to your overall contract where the number of options what you have, in other words the option size is 100 shares. So finally the gain per share is rupees 100 and the lot size is 100 shares. So total payoff what you get will be 10,000. So now you are holding call option as well as put option. Call option payoff is 0 but put option payoff is 10,000 rupees. Finally the net payoff will be 0 plus 10,000, the overall gross payoff, and minus the amount of premium expenses that you have incurred. The net profit or net payoff would be rupees 6,500. So please take note of all these calculations as well and then we shall move ahead. Alright friends, let us move ahead and take up the last scenario where we would say if the price of the stock rises to rupees 600 after 3 months. Look into what happens to call option. Market price is 600 and exercise price is just 550. Now we find that market price is greater than exercise price, therefore the call option will be exercised. You know why? Call option will always be exercised when market price is greater than exercise price. And now payoff for each of this call option will be 600 minus 550 and option size is 100 shares. So that will be 50 multiplied by 100, giving you total payoff of 5,000. Now what happens to put option? Market price is 600, exercise price is 450. We know one thing very well, that put option is exercised only when market price is less than exercise price. This is not that scenario. That means put option will lapse and its payoff will be 0. Finally, the overall payoff from holding both the call and put option is 5,000 plus 0 and the premium that you have paid early was 3,500. So finally the net profit what you get at the end is 1,500. So take note of these calculations as well and that will be end of the solution.
Alright friends, once you have completed this particular solution, let us move ahead and take up the next question, that is question number 3A. As per your textbook, this question is classified as question number 43 from the part of derivatives options, which happens to be a question on currency options. Let us deal with this. XYZ Limited, a US firm, will need pound 3 lakhs in 180 days. In this connection, the following information is available. Spot rate is given as pound 1 equals to $2 and 180 days forward rate is given as pound 1 equals to $1.96. Interest rates are as follows. They have given 180 days deposit rate in UK and US, 180 days borrowing rate in UK and US. A call option of pound that expires in 180 days has an exercise price of $1.97 and premium of $0.04. Now further the question informs, XYZ Limited has forecast of the spot rate 180 days hence as below. Probabilities have been given along with the future rate. So basically, don't get confused with the word futures. This is not currency futures. This is the company's own expectation of what would be the rate that will prevail in the future, and these rates have been given along with the respective probabilities. Which of the following strategies would be most preferable to XYZ Limited? First is the forward contract, second one is the money market hedge, third one is the option contract, fourth one is no hedging. Show calculations in each case. Of course, we will be showing the calculations in each case. So the first thing that you need to do, what I find the easiest thing would be to deal with forward contract. Why? Let me take you back to the question. Look at this whole information. XYZ Limited is a US firm. First of all, you have to make your mindset very clear that you are not an Indian company over here. You are an entity operating in the US. Your local currency is US dollar, and therefore the foreign currency will be pound. Now, what they have given, US firm will need 3 lakh pounds. What does this line mean? That means, are you going to receive a payment of 3 lakh pounds, or do you have a need to make a payment of 3 lakh pounds? When this line is read again, US firm will need 3 lakh pounds. That means the company will have to buy pounds. Indirectly, what I consider, this US firm must be an importer and the supplier is the entity from UK. Anyway, this company will have to make a payment in pounds, and finally, if you have to buy pounds, you should understand one thing, that the spot rate of today is definitely not relevant. 180 days forward rate is definitely relevant for the forward contract, and that forward rate is $1.96 per pound. So if you want to buy 3 lakh pounds, 3 lakh pounds multiplied by $1.96 per pound will be your outflow under forward contract. If you go with the route of no hedging, what can happen? You have no idea about what will be the rate in future on actual basis. You just have made a forecast. So your forecast may be correct, may be wrong. Anyway, what we will do is, the respective rates will be multiplied to their respective probabilities to arrive at a probable rate that you might expect to prevail in the future. That rate multiplied to 3 lakh pounds will give you the outcome of no hedging. Thereafter, the question talks about money market hedge. Now, money market hedge we have learned in Forex. Let me again take you back to the initial part of the question. Look at this point. They have given you the money market rates, correct? And therefore the money market hedge is possible. How do you plan a money market hedge? For a money market hedge, you are an entity operating in US and you have a need to make a settlement in pounds. That means you have a pound denominated liability. To create a money market hedge, you have to create a pound denominated asset, and that should mature along with this liability, that is after 180 days. So what you should do, you should make investment in pounds, so much pound you invest today, so that after 180 days, the value of that investment should match with pounds 3 lakhs, so that that investment can offset this liability. And to do that, you will have to buy some quantity of pounds today, whatever is the present value of this 3 lakh pounds. That much quantity of pound you will have to buy today. To do that, you need to now apply the spot rate of pound, correct? Here the spot rate of pound becomes relevant. Now, if you have to buy pounds today, you will have to arrange money, and arrangement of money will be in US dollar. So you borrow money denominated in US dollar, enough money to buy so much quantity of pound which can be invested today, and will have a maturity value of 3 lakh pounds. So how much money you have to borrow, that you can figure out, and for that purpose the US rates should be considered for borrowing. So your relevant rate will be the borrowing rate prevailing in the US. On the other side, because you are going to make investment in UK, the relevant rate will be the 180 days deposit rate in UK, that is 4.5%. So you are going to borrow at 5.5% in the US and convert the US dollar into UK pound by using the spot rate, and then invest that obtained amount in UK at 4.5%. Mind it, these rates are always to be interpreted as per annum rates, and because they have given 180 days, I will be considering that there will be 360 days in the year. So indirectly there will be simply half of these rates which will be applicable for 180 days. Now this is how you are going to create a money market hedge position. Now what about option contract? So you definitely have a call option as per what we have discussed in today's class. Because you want to buy pounds and a call option of pound is given, so of course you have to become a call option holder and you will have a right to buy pounds at 1.97. So if the price of pound is greater than 1.97 after 180 days, then you exercise your call option, otherwise you let your call option lapse. But to enter into this option contract, today you will have to pay premium of $0.04 per pound. $0.04 per pound multiplied by 3 lakh pounds, the total amount of premium payable will be 3 lakh multiplied by 0.04, that will give you what? $12,000. So $12,000 will be your premium payment today, and that money again you will arrange in the US locally by borrowing for 180 days at 5.5% per annum. So whatever be the interest thereon, even that will be part of your outflow. So we are going to finally evaluate the outflow under each of these 4 alternatives and finally decide what would be the best course of action for the company. So let us start solving the question step by step, and to begin with we will go with calculation of expected spot rate after 180 days. I have already explained to you, you consider your expectation of the future rate, that is the spot rate that would prevail after 180 days, multiply the probabilities given to you, that is future rate multiplied by probabilities on respective basis, and the aggregate value in the last column will be the probable rate that you are expecting, and you would better call it as expected spot rate, and that is $1.955 per pound. So if you are going to the route of forward contract, you simply multiply 3 lakh pounds with $1.96 per pound and you get the outflow as $5,88,000. And from where did we pick this? This is the forward rate given to you already. If you go with the option of no hedging, then simply 3 lakh pounds will be multiplied to your expectation of pound rate that would prevail after 180 days, and that is $1.955. Multiplying this rate, we will find that it is lower amount of outflow as compared to forward contract. But keep one thing in mind, when you are going with no hedging, this is just your expectation. There is no certainty about this. Keep that thing in your mind. So eventually, if you have to answer that it will be better we go with no hedging, then you should keep in mind that no hedging option is still putting you at the risk. That means your foreign exchange exposure still continues. You have not covered your position if you go with no hedging. However, that decision we will be taking at the end after comparing all 4 alternatives. First, what you do is write up these calculations quickly and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and continue solving the question further. We would say in the third alternative that outflow after 180 days, if the company plans a hedge through money market hedge, or we can say through money market operations, the company has a liability of pound 3 lakhs. For money market hedge, the company should first create an asset with a maturity value of pound 3 lakhs by investing the present value of the desired amount. Amount to be invested in UK at 4.5% per annum for 180 days will be, just find the present value. So, because you have to invest at the rate of 4.5% per annum, you will be taking for 180 days the equivalent rate, and that will be what? 2.25%, and 1 plus 2.25% will become 1.0225. That becomes the factor. So, to find the present value, take 3 lakhs divided by 1.0225, and what you get is pound 2,93,398.53. This is the pound quantity that you should buy today so that you can invest this money in UK at 4.5% per annum for 180 days. That will give you a maturity value of 3 lakh pounds, and that investment maturity value will be offsetting your pound liability, which is pound 3 lakhs that is due after exactly 180 days from now. So please write up this part of the solution and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead, and now we would say this amount should be acquired by buying at spot, that is $2 per pound. So you will be buying this at spot rate, and amount required in dollars will be the quantity of pound that you have to buy today multiplied by $2 per pound, which will give you $5,86,797. This dollar quantity you will be borrowing locally for 180 days at the rate of 5.5% per annum. So the interest amount thereon will be the principal into 5.5% into 180 by 360. That comes to 16,136.92 US dollars, and the amount that you will have to pay after 180 days as per money market hedge will be aggregate of the principal borrowed plus interest thereon, and that comes to $6,02,933.92. So please write up this as well, and then I take you ahead. Alright friends, once you have completed writing this whole thing, let us move ahead and now talk about the option contract. So what we have, expected price, and expected price, we have not one but 3 different expected prices that the question has informed, and that price is the price of pound in terms of dollar. So what I have written is the price as $1 per pound. Now action at the expiry, that is action after 180 days at an exercise price of 1.97, that is $1.97 per pound. So you are going to decide whether you should exercise the option or let it lapse. Don't forget, you are a call option holder over here. So if the expected price is 1.91, what would you do with your call option? So use your simple common sense that the spot rate, if it is 1.91, that means I can buy pounds by paying 1.91 USD. Why should I exercise the call option and buy the same at 1.97? So I will let the option lapse. So I'm just writing the word lapse over here. So my outflow will be purchasing 3 lakh pounds not at this rate but at 1.91. So my outflow will be 3 lakh pounds multiplied by $1.91 per pound, and that would give you $5,73,000. But the probability of occurrence of this outflow is given to you as 0.25. So because we want to find the expected value, we will multiply the expected outflow with its respective probability. So X into P would give you 143,250 for this particular line. The next line, you will write your expected price of pound as $1.95. The exercise price is 1.97. Of course, you are not going to exercise your option because for exercising the call option, it is the market price that should be greater than exercise price, correct? So here again in the second line, the option will lapse and your outflow will be 1.95. Simple point is, when your outflow can be managed at 1.95, why should you pay 1.97? So we will continue to compute the outflow in the same way, but now taking the rate of pound as $1.95 per pound, and we get 3 lakh pounds into $1.95 per pound, which will give you $5,85,000 as your outflow. But the probability that this will be your outflow is given as 0.60, and now what you do is, this outflow will be multiplied to its respective probability, and the expected value column will have this as its second element. Third and last line, you will find that the expected price of pound is $2.05. This is the point where your call option becomes exercisable, because it will be cheaper to buy dollars at 1.97 rather than buying dollars at 2.05. So simple idea is, if you are holding a call option for pound, you will be able to buy pounds at 1.97 or a cheaper rate, definitely not a rate bigger than that, not a rate higher than that. So here you will exercise your option, and your outflow this time will not be as per the prevailing rate, but as per your option exercise price, and that will be $5,91,000, but this has a probability of 0.15. And finally, the expected value column will have this amount. Now these are not your outflows, okay? The aggregate of these three values will be your outflows. Why? Your outflow could be either this or this or this. Out of these three, anything could be your outflow, and these three outflows have respective probabilities as 0.25, 0.60 and 0.15. So your expected value of your outflow will be the respective amount of outflow multiplied to the respective probability, and finally your probable outflow after 180 days will be aggregate of X into P, that is 5,82,900 in terms of US dollar. Don't forget that you would have arranged this call option contract by paying a premium. Premium was $0.04 per pound, and for 3 lakh pounds the total premium works out to 12,000 US dollars. And this 12,000 US dollar 180 days back you would have arranged at 5.5% per annum. That was the local borrowing rate in US. So the interest thereon will be $330. So your final outflow after 180 days would be aggregate of all these factors, and that comes to $5,95,230. So write up this whole working systematically, and then I take you ahead. Alright friends, I am sure you have finished writing this whole working. Now we have outflows available for all the three alternatives. So let us compare and conclude. So what we find, the lowest possible outflow is appearing in no hedging. We would say it appears that it will be beneficial not to take any type of hedge to minimize the expected outflow. That is, the alternative of no hedging will be preferred. However, doing so, the company will remain exposed to the risk of foreign exchange rate fluctuation. So this is your final conclusion. I would give you one more note over here, because otherwise you may be getting confused if you see the solution in ICAI material. The interest rates are always considered as quoted on per annum basis. However, when you look at ICAI material, I would say the solution given by ICAI is slightly different, because there interest rates have been interpreted as half year rates. So please do not follow that solution, follow the solution that I have provided to you. So please write up this whole thing, and that will be end of this whole solution. Alright friends, once you have completed this solution as well, let us move ahead and now take up question number 3B, and this happens to be question number 40 from the derivatives options part, which is a question on Black-Scholes model.
Current market price of the share is given as rupees 120. Exercise price of the option is given as rupees 115. Duration is given as 3 months. Standard deviation of the share price is 60%, and continuously compounded risk-free interest rate is given as 10%. Determine the value of call option using Black-Scholes model, and also determine the value of put option at the same exercise price. If call option premium is rupees 16, what action would you take? If put option premium is rupees 18, what action would you take? So at the end, we have to see whether you should buy such option or sell such option for the prices that are mentioned in point number 1 and 2. So that will be one additional part. Otherwise, the question is straight and simple. So let us see how to present the solution. In this solution, you would write up the important equations and formulas. You know this, you have to write it all the time when you are solving a question by Black-Scholes model. So write up this quickly, and then we shall define all these variables. Alright friends, after writing up these important equations and formulas, we move ahead and define all the variables, and I don't have to explain you again and again. All these variables, you know it very well, but it is important thing that every time you solve a question, you write up the meaning of all these variables. Make sure that you have written all this every time you solve a question on Black-Scholes model, and once you finish writing this, we start applying the steps and solve the question. Alright friends, after writing up the definition of all these variables, let us substitute the values of these and apply step by step all the calculations, beginning from D1 calculation. D1 formula you need not write again, but yes, all the values will be substituted and you will find the value of D1. Value of D1 would be finally 0.03922 plus 0.07 divided by 0.3. What you get is rounded off to 0.36 as the value of D1, and now you will determine D2. D2 would be simply D1 minus sigma into square root of t, and that comes to 0.06. So friends, if you have already written all this, you may just skip a few minutes. If not, write it down right now. Alright friends, let us move ahead and determine the value of n of D1 and n of D2. This time I have not presented the diagram of that bell curve, and I told you every time it is not needed. It was mainly given for your reference, and neither I am explaining how you got the values of n of D1 and n of D2. You know it very well. Just make sure that while you have attempted the calculations, you exactly got this, and the description that you find on screen should be mentioned as part of your solution. You don't write this explanation, you will not be rewarded with proper marks. So write up this if you have yet to write. Already written this, you may simply move ahead. Alright friends, after writing up these two steps, let us move ahead and apply the equation and determine the value of call and put option. So value of call option comes to 18.40 and value of put option comes to rupees 10 exactly. So write up this also, and don't forget we have yet to write up the conclusive part. So first make sure that you have written answers of these two parts correctly. So I am waiting for you. Write it up quickly. If you have already written, just move ahead and check the remaining part of the solution. Alright friends, after writing up the calculation of value of call option and put option, let us move ahead and conclude the last part. So we have just found the value of call option as 18.40 and the call option premium quoted in market is rupees 16. So what do we find? That the call option is underpriced and it is advisable to buy this call option. And the value of put option, what we got was rupees 10. but put option premium quoted in market is rupees 18. So this put option is overpriced. It is advisable to sell this put option. So please write up this also, and that will be end of the solution.
Alright friends, once you have completed this particular solution, let us move ahead and take up the next question, that is question number 3C. And as per the textbook, this will be question number 45, again from the part of option valuation, that is from the derivatives option part. Let us deal with this. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at rupees 600 each. He expects that the price of share may go up to rupees 780 or may go down to rupees 480 in 3 months. The chances of occurring such variations are 60% and 40% respectively. A call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of rupees 630. What combination of share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of option today? The risk-free rate is 10% per annum. And lastly, they are asking what is the expected return on the option. So first of all, whenever you get a question like this, where the question primarily is asking you the combination of share and option, the only model that will fit over here is the portfolio replication model. And you know what you have to do under portfolio replication model. You will find the spread in the share price, which will be gap between 780 and 480, that is higher probable price minus lower probable price. That is one thing. Second thing, you find the value of call option at this price, where it will be market price minus exercise price, because the option will be exercised. So 780 minus 630, it will give you 150. And when the market price goes down to 480, the exercise price being 630, the call option will not be exercised, it will be lapsed, and therefore the value of the option in that scenario will be 0. So value of call option can be either 150 or 0. So the spread in the option value will be 150 minus 0, that is 150, and the spread in share price will be 780 minus 480, that is 300. And through this you can find a connection between the number of call options against each share, and that is what required in the first part. Then performing other steps in portfolio replication model, you can arrive at the value of option in today's terms, and then you also work out the probable value of option on expiry, because the probabilities of rise and fall in price is given with the probable value of option on expiry, and comparing that with the value of option today, you will be able to find the expected return on the option over the period of 3 months. So let us look into how to present the solution over here. In the solution, you first write determining the value of call option using portfolio replication model. The first step will be determine the spread between the two probable market prices expected by end of the period. Spread will be higher probable price minus lower probable price, that is 780 minus 480, and that will give you rupees 300. Second step will be determine the spread between the two probable option values expected by end of the period or on maturity, which will be after 3 months, and the spread will be option value at higher probable price minus option value at lower probable price. As I have explained you, it will be 150 minus 0, that is 150. But how we got this 150 and 0, we will be showing that by way of a separate working. I have given that reference over here as working note number 1. So please write up this part of the solution, and then I take you ahead. Alright friends, once you have completed writing this part of the solution, let us move ahead and first look into the working note 1, which will give you the spread in the option value. So option value for call option, when it is exercised, it is market price minus exercise price. At higher probable price, if it prevails, that is 780, option value will be 780 minus 630 because the option will be exercised. If the lower probable price prevails, that is 480, the option will be lapsed and its value will be 0. That is why the spread in the option value will be 150 minus 0, and that was 150. Quickly take note of this working and then I take you ahead. Alright friends, once you have completed writing this working note, let us move ahead, and what we now do is we say determine the number of call options to be contracted against each equity share. That is what we symbolize as N. So N will be spread in probable share price divided by spread in probable option value. In the earlier classes of option valuation, we have logically understood this whole thing, right? So as of now, you just have to take up this as your practice question. So I am not explaining those typical logics over here. So it will be basically 300 by 150, and that comes to 2 call options. We would now say for creating a perfect hedge, Mr. Dayal should purchase 1 share for 2 call options, or in other words we can say 2 call options for every 1 share. So please write up this third step and then I take you ahead. Alright friends, once you have completed writing this third step, let us move ahead and continue further. In the fourth step, we will formulate the equation and determine the present value of call option. And for this purpose, what we do is the equation for portfolio replication model is S0 equals to N into C plus PV of lower probable price or exercise price, whichever is lower. So it will be S0, which is the current market price of the share, which is given as 600. Then we have 2 into C, N value we have just obtained as 2, so 2 into C plus PV of lower probable price or exercise price, whichever is lower. So between the two we are finding the lower probable price as lower. So in the next line we will write 600 equals to 2C plus 480 divided by 1.025. So basically the risk free interest rate is 10% per annum, but the option will expire after 3 months. So proportionately 3 months effective interest rate will be 2.5% or 2.5%. So the factor over here will be 1 plus 0.025, that will give you 1.025. And when you find the present value of 480, what you get is 600 equals to 2C plus 468.29. So 2C will be 131.71. So value of C will be 65.85. So the present value of call option as per portfolio replication model is 65.85. So please take note of this part as well, and then I take you ahead. Alright friends, after completing this much, question has asked you one more thing, that what will be the return on the option. So currently the option is available at 65.85, which we are considering as the price of the option, and because the actual price is not given, we are assuming that whatever be the option value, because it is the present value of option, we are considering the same as the price of the option prevailing in the market today. That means if we are buying this call option, we are buying it for 65.85. Moving forward, we would say the expected return on the option will actually depend upon the value of the option on expiry, that is the expected value of the option on expiry. We know one thing, that there can be two probable values of the option, either 150 or 0, and the probabilities are 60% and 40%. So the expected value comes to rupees 90. So what will be the expected return? It will be 90 minus 65.85 divided by 65.85, and this will give you returns of 36.67%. Kindly note one thing, that this rate of return what we have obtained is not an annual rate of return. This is the rate of return for the holding period of 3 months only. That means through this option, the party Mr. Dayal can earn 36.67% over 3 months. So please write up this whole thing, and that will be end of the solution. Alright friends, once you have completed this particular solution, Let us move ahead and take up the next question. That will be question number 4A. And from your textbook, it is question number 12, picked up from the chapter Interest Rate Risk Management, and it can be even titled as Interest Rate Derivatives. Question number 12.
Two companies, ABC Limited and XYZ Limited, approached the DEF Bank for FRA, that is Forward Rate Agreement. They want to borrow a sum of rupees 100 crores after 2 years for a period of 1 year. So understand one thing, they want to borrow after 2 years but only for a period of 1 year. The bank has calculated yield curve of both the companies as follows. So they have given yield curve for year 1, year 2 and year 3 for both the companies, and you find that the case of ABC Limited, the rates are substantially higher, and they have even given you the reasons why the rates are higher. The difference in yield curve is due to the lower credit rating of ABC Limited compared to XYZ Limited. Further, what is required? You are required to calculate the rate of interest DEF Bank would quote under 2/3 FRA using company's yield information as quoted above. So friends, the way in the earlier example we have learned how to calculate 2/3 FRA rate, exactly same thing you have to do over here. Then the later part of the question is asking you, suppose bank offers interest rate guarantee for a premium of 0.1% of the amount of loan. You are required to calculate the interest payable by XYZ Limited if interest rate in 2 years turns out to be 4.5% and second case is given as 5.5%. So friends, the second part of the question depends upon the information that you will draw from the first part. I mean the calculation that you will make in the first part. So let us first deal with the first part, and what we do is DEF Bank will fix interest rate for 2/3 FRA after 2 years for XYZ Limited as follows. It will be 1 plus R into 1 plus 0.0420 raised to 2 equals to 1 plus 0.0448 raised to 3. Friends, it is very important for you to understand the formulation of this equation before you start solving it. So as I have explained in the earlier example, you are computing 2/3 FRA. So we have considered the rate of that FRA as R. So the first 2 years you are going to pay interest at the yield rate of 4.2%. So it will be 1 plus 0.042 raised to 2. And for the third year, the applicable rate is R. So we have multiplied 1 plus R. And obviously this would match with the yield rate of 3-year bond that will be offering 4.48% per annum. So 1 plus 0.0448 will be raised to 3 times. Now when you solve this equation, you will get the value of R. So 1 plus R equals to 1.0448 raised to 3 divided by 1.0420 raised to 2. 1 plus R will be 1.1405 divided by 1.0858, and finally 1 plus R is 1.0504. So R will be 1.0504 minus 1, that will be 0.0504 or 5.04%. So bank will quote 5.04% for a 2/3 FRA to this company XYZ Limited. So friends, this calculation, once you understand, the calculation of the other company will be done exactly the same way. So finish writing this calculation quickly. Alright friends, after writing up this, let us move ahead and make the similar calculation for the other company, that is ABC Limited. Here it is exactly the same thing, same way. I have no explanation to offer. You know how to do it, exactly the same thing earlier. Just see, in the same style we have presented the solution as well, and what you get over here as value of R is 6.38%. So to this company ABC Limited, bank will quote a higher FRA rate, that will be 6.38%. Note down this as well, and that will be the answer for the first part of the question. Alright friends, you would have finished writing even this. Let us move ahead and deal with the second part of the question. Now this is going to be very simple. So there are two cases given to you where the interest rate after 2 years would be 4.5% and 5.5%, correct? And they have stated that XYZ Limited has taken an interest rate guarantee contract by paying a premium. So you remember what was the rate for XYZ Limited, correct? It was 5.04% in the first case. So what would happen if the interest rate prevailing is 4.5% and there is an interest rate guarantee contract under FRA? Obviously XYZ Limited is not going to exercise this option because the rate is substantially lower than the FRA rate offered by bank. FRA rate offered by bank was 5.04% and this prevailing rate is simply 4.5%. So in that case, what happens to the option? You simply let it lapse. What happens when it is case 2? Obviously you would exercise the option and borrow money not at 5.5% but at 5.04%. So here the option will be exercised. So let us compute the interest on 100 crores. In the first case, it will be at 4.5%. In the second case, it will be not at 5.5% but at 5.04%. But in either case, you will have to pay premium, and premium cost was the loan amount into 0.1%. So that will be 0.1 crores in either case. So final outflow would be aggregate of interest payment plus the premium, and that will be 4.6 crores and 5.14 crores in these two cases. So you can see wherever the interest rates are lower, you don't have a commitment to unnecessarily borrow at FRA rate and your interest cost can be brought down. Where the interest rate is higher, you may exercise your interest rate guarantee option and you may eventually end up paying lesser amount in total. Otherwise you would have paid at what rate? 5.5%. So that will be end of the solution. So please take note of this whole thing carefully.
Alright friends, once you have completed this entire solution, let us move ahead and discuss the next question, that is question number 4b, which is again picked up from interest rate risk management or interest rate derivatives. From the book, it is question number 16. Let us deal with this question.
XYZ issues a $10 million floating rate loan on July 1, 2013 with resetting of coupon rate every 6 months equal to LIBOR plus 50 basis points. XYZ is interested in a collar strategy by selling a floor and buying a cap. So first of all friends, XYZ company has issued a floating rate loan. First of all, it has issued a loan, means issuing a loan means issuing a debenture or issuing some kind of bond or debt instrument, means as good as you are borrowing money. So this company is typically a borrower and this company wants to hold a collar strategy by selling a floor and buying a cap. So obviously this kind of strategy would suit the borrower. So XYZ buys the 3-year cap and sells 3-year floor as per the following details available on July 1, 2013. Notional principal amount is $10 million. Reference rate is 6-month LIBOR. This time they have not given any plus or minus values to this LIBOR. However, they have initially mentioned LIBOR plus 50 basis point for the application of the agreed interest rate. Strike rate, they have given 4% for the floor and 7% for the cap. That means 4% becomes the lower limit and 7% becomes the upper limit. Premium is 0. I told you earlier, in most cases in the caller option the premium would be 0. Here in the question they have given even the reasons for premium to be 0, since premium for cap equals to premium for the floor, that is premium paid for the cap equals to premium received for the floor. So no settlement of premium required. Now further the question is asking you, using the following data you are required to determine effective interest paid out at each reset date and average overall effective rate of interest per annum. Now reset date and LIBOR rates have been given to you. Now friends, you look into one thing. This is a total loan of 3-year period and every 6 months you are resetting the date. So obviously what will happen, the total number of periods will be 6 periods of 6 months each, because it totals up to 36 months. You can see this question is asking you calculations for all the 6 reset periods. Let us see how to present the solution. In the solution, you would first make a statement showing effective interest paid out at each reset date. And what I am doing, friends, I am showing only 3 reset period calculations at a time because of the limitation of space. So the heading will be reset date, LIBOR, number of days, interest payment at LIBOR plus 0.5%, cap receipt, floor payment and effective interest. Now, reset date, the first reset date, LIBOR is given as 6%, number of days. So the period started from 1st July 2013 and ends on 31/12/2013. As a result, if you count the number of days accurately, it comes to 184 days. Now, the interest payment will be at LIBOR plus 0.5%. Look into one thing, LIBOR is 6 and 0.5% added to LIBOR, it will be 6.5%. So how do you calculate the interest? It will be $10 million multiplied by 6.5% into 184 by 365. So it is 327,671. I repeat the calculation base for you. How to get this value? The amount of loan is $10 million. $10 million multiplied by 6.5% into 184 by 365 will give you interest of 3,27,671. I am sure you are clear with this, correct? Then whether there will be any cap receipt or floor payment. So you just have to look into one thing, is any option getting exercised? So cap limit is 7%. Here effectively the rate of interest is LIBOR plus 0.5% means 6.5%, but cap limit is 7%. So cap option is not exercised. What happens to floor option? Even floor option is not exercised because the floor is 4%. So both these options get lapsed. So neither there is any cap receipt nor there is any floor payment. So effective interest is the same amount of interest that you have calculated. We are calling this as A, this as B, this as C. So if there is any effective interest payment, it will be A minus B plus C. Why? Because this is the interest to be paid, this is the cap receipt and this is the floor payment. So payment, receipt and payment. So net amount will be A minus B plus C. And here in this case it comes to 3,27,671. Once you understand one line calculation, you should be able to do the calculation for all others. Anyway, I am guiding you over here. So it is 30th June 2014 as the next reset date and the LIBOR rate given is 7%. If LIBOR is given as 7%, you have to count the number of days from 1st January 2014 to 30th June 2014. It will be 181 days. And now compute the interest payment. LIBOR is 7% and the agreed rate is LIBOR plus 0.5%. That means it will be 7.5%. Now take $10 million multiplied by 7.5% into 181 by 365. the amount of interest comes to 3,71,918. Now what will happen? The cap gets triggered, correct? Because your upper limit is 7%. So cap gets triggered and you get that differential as your receipt. How to compute this? I'm going to show you in a while. Basically, this is nothing but the differential rate. So that differential rate between 7% and 7.5%. 7% is the LIBOR rate and 7% is also the cap rate. But this effective rate is 7.5%. So 7.5% and the cap rate difference, that is 7%, that is 0.5%, will be applied on $10 million into 181 by 365. I repeat the calculation. You take the interest rate differential of 0.5% and apply that 0.5% over $10 million into 181 by 365. So if you have to calculate it, take $10 million into 0.5% into 181 by 365 and you would get 24,795. So floor payment will be obviously zero. Either cap option gets exercised or floor option, both cannot get exercised parallelly. So cap receipt this time is 24,795, floor payment is zero. The effective interest would be reduced down to 3,47,123. The next reset date is 31st December 2014. LIBOR is 5. So number of days will again be from 1st July to 31st December of 2014. It will be again 184 days. You can now calculate interest on your own. You should not be dependent upon me. This interest, how will you calculate? $10 million into 5.5% into 184 by 365. That gives you 277,260. Now whether cap receipt and floor payment would arise or not, let us check. LIBOR is 5, agreed rate is LIBOR plus 0.5%. So agreed rate will be 5.5%. Cap limit is 7 and floor limit is 4. So it is between the cap and floor. So there will be none of this option will be exercised. As a result, cap receipt is 0, floor payment is 0, effective interest will be same as the interest calculated, that is 2,77,260. Now how do we get this 24,795? Let us show the calculation. As I told you earlier, it will be $10 million into the differential of interest rates. Let me remind you once again, what is this difference about? 7.5% was the effective rate in the second reset period. Why? Because LIBOR was 7 and agreed rate is 7.5 because it is LIBOR plus 0.5. So this is the agreed rate with a cap limit of 7%. The differential comes to 0.5% and it will be applicable for 181 days. So it is $10 million into 0.5% into 181 by 365 would give you $24,795. Friends, I have given you all the possible explanation for the first 3 reset periods. I would want you to take your time, note down all calculations. I will give you little additional time to work out the other 3 reset period calculations. After going through these 3, you should be able to work out the next 3. So take your time, work out all 3 and then proceed ahead with the solution. First write down this, then calculate for the other 3 lines. Your time starts now. Alright friends, you would have finished writing these calculations and I am sure you would have attempted the calculations ahead also. So what I am doing now is I am going to just show you the calculation for the next 3 reset periods. You need to match up your answers. Whatever you got, just try to check with the calculations that I would show over here. So the 4th reset period, the calculation will be, number of days will be 181 days. The amount of interest will be 2,10,753. Cap receipt 0. Floor payment also 0. You know why it is like that. And effective interest will be same what is the amount of interest. Next reset period, the LIBOR rate is 3.25. The effective rate will be LIBOR plus 0.5%. So now it will become 3.25 plus 0.5%. That will be 3.75%. Do you see it is going below the floor? So this time the floor option will get exercised. The number of days are 184 days. Interest works out to 1,89,041. Cap receipt will be 0, but floor payment would arise. How do we get this 12,603? We will show that working, and effective interest is 2,01,644. Last reset period, the LIBOR rate is 4.25%. Number of days are 182 days. Mind it, it's a leap year 2016. So from 1st January to 30th June, it will be 182 days. And now interest payment will be calculated based on 4.25 plus 0.5, that is 4.75%. So I'm sure you would have got these interest payments, and here because the effective rate is 4.25 plus 0.5, the effective rate will be 4.75%. None of these two options will be exercised. So cap receipt is 0, floor payment is also 0. Effective interest will be 2,36,202. So finally we calculate the number of days. Overall it is 1096 days, and total effective interest for all 6 reset periods comes to 16,653. So now let us show one more thing. How do we get this 12,603 as a working? So it will be $10 million into 3.75 minus 4, that differential interest, and into 184 by 365, and that gives you the floor payment of $12,603. So friends, I'm sure you would have calculated the same, but I am still giving you time to rethink and write up. If you haven't written it or if you have made errors, try to rectify. So I'm giving you time. Take your time, understand all calculations and write them down. Alright friends, you would have completed all these calculations. Let us now move ahead. The question has asked you to work out the average overall interest rate. So for that, simply what you do is the overall effective interest payment will be divided by the amount of borrowing into 365 by 1096, and that will be giving you the effective rate of interest for an overall period of 3 years as 5.33% per annum. So note down this as well, and that will be completion of the solution.
Alright friends, once you have completed this solution, let us move ahead and deal with the next question, that is question 4C. And from the textbook, again this is a question from interest rate risk management, question number 11 from there.
Consider the following data for government securities. You can see one thing. Face value of the 3 different government securities given to you, and their years to maturity are 1 year, 2 year and 3 year. Their current price is also given, and coupon rate offered by the bond is also given, and you have to simply compute the forward interest rate. So friends, how you are going to do, once you have learned the concept of yield curve, making the forward rate calculation is no big deal for you. Let us begin with the first part, and the first part you will have to take the first year maturity bond, that is the first bond, right? That means in the sequence you will have to start with this, followed by the second year maturity, because by then you would have got the first year rate. Through that you will find the second year rate, and through both of these information you will be finding the third year rate. So you have to begin with the bond which has remaining maturity of only 1 year. So let us see how to present the solution. In the solution, you will be finding the 3 years different rates as I1, I2 and I3. So as I said, you will take the 1 year maturity bond at the first. As per the bond valuation concept, the present value is nothing but the future value divided by 1 plus desired yield rate, and Here, because it is 1 year maturity bond, the interest rate for year 1 we have taken as I1. So present value of the bond is already given as 91,500 and future cash flow will be 0 plus 1 lakh. Why this 0? Because if you see the first year bond, that is 1 year maturity bond, does not have any coupon payment being offered. So coupon payment is 0, but the redemption value will be at par, that is 1 lakh. So this future cash flow divided by 1 plus I1 gives you the present value of 91,500. By cross multiplication, you would get 1 plus I1 as 1 lakh divided by 91,500. 1 plus I1 is 1.0929. So I1 will be 0.0929 or 9.29%. So do one thing, write up this whole thing and then we move ahead. Alright friends, you would have finished writing these calculations. Let us move ahead and deal with the 2-year maturity bond, which has the present value of 98,500. So let us first set up that equation. Let me explain you what is this. The first year, the cash flow will be only the coupon payment for the first year, which will be discounted to its present value using the first year applicable rate of 9.29%. So 10,000 coupon payment divided by 1.0929. Now in the second year you will be getting coupon payment of 10,000. Along with that you will get the redemption value of 1 lakh. So 10,000 plus 1 lakh would give you in total 1,10,000 of future cash flow after 2 years. Because it is cash flow after 2 years, you would discount it for 2 years. For that what we generally do is 1 plus I whole square. But this time we have different rates. So the first year will be 1 plus I1 and second year will be 1 plus I2. So instead of taking 1 plus I whole square, we would take 1 plus I1 into 1 plus I2. Now I1 was already known, that was 9.29%. So that we have placed as 1.0929, that is 1 plus I1, and 1 plus I2 is not known in terms of I2. So I2 will be obtained through this whole equation. So once you have formulated the equation correctly, solving equation is no big deal. So let us solve this equation. So 98,500 in the left hand side as it is, 10,000 divided by 1.0929 will give you 9150, and the last term is 1,10,000 divided by 1.0929 into 1 plus I2. When you move this 9150 to the left hand side, it gets subtracted, and what you will get now in the left hand side will be 89,350 equals to 1,10,000 divided by 1.0929 into 1 plus I2. Cross multiply and you get 1 plus I2 equals to 1,10,000 divided by 1.0929 into 89,350, and finally 1 plus I2 value is 1.1265. So I2 will be 0.1265 or 12.65%. So friends, carefully take note of this, and that will be end of the second part. Alright friends, you would have finished writing this much. Let us move ahead and deal with the last part, taking the 3-year maturity bond for finding the FRA rate for the third year. So this time the equation would be little longer. The present value of the bond is given as 99,000. Its coupon rate is 10.5%. So coupon payment each year will be 10,500. And it has 3 years remaining for its maturity. So coupon payment for first year, coupon payment for second year, coupon payment for third year, and at the third year you would also receive the redemption value. So in the numerators we have taken all the cash flows in future that would arise. In the denominator, what you would do is, this first year cash flow will be discounted using the first year interest rate, that was 9.29%. Second year cash flow will be discounted by taking the multiple of the factor of the year 1 and year 2, and third year cash flow will be discounted by taking the multiple of factor of year 1, year 2 and year 3. So because year 1 and year 2 rates are known, what you would simply do is, you will take 1.0929 1.0929 into 1.1265, and that will be multiplied to 1 plus I3. So I3 is the only unknown factor in this whole equation. Once you formulate this equation, you can easily solve it. So it will be 99,000, that is equal to 10,500 by 1.0929 would give you 9607. The second term, that is 10,500 divided by product of 1.0929 into 1.1265 would give you 8529. And the third term, as it is, what we have done, the multiplication of these two we have applied over here as 1.23115. That is, these two multiplied, you get 1.23115. Now what you would do is take both of these values to the left hand side. Obviously aggregate of these two will get subtracted from 99,000, resulting into 80,864, and this third term in the right hand side remaining as it is. Now by cross multiplying, you would take 1 plus I3 equals to 1,10,500 divided by this 1.23115 as it is, and 80,864 gets multiplied to this 1.23115. Finally, when you solve it, you get 1 plus I3 as 1.1099, and I3 will be 0.1099 or 10.99%. So friends, take note of this as well, and that will be end of the solution.
Alright friends, once you have completed this solution, let us move ahead and take up the next question, which is question number 5A. And this happens to be a question from Forex. From your textbook, it is question number 59. Let us deal with this. JKL Limited, an Indian company, has an export exposure of JPY 10 million, payable August 31, 2014. So let us first interpret the very first line. This is about an Indian company that has an export exposure, and they have mentioned this amount as Japanese yen 10 million, payable in August. So don't get carried away with the word payable. This is just to confuse you. You are an exporter, and if you have an export exposure of Japanese yen 1 crore, then you are going to receive Japanese yen 1 crore. The word payable indicates payable from the viewpoint of the counterparty. You are definitely going to receive this amount, and this is payable August 31st, 2014. JPY is not directly quoted against INR. The current spot rates are. Now notice one thing, Indian rupee is connected with US dollar, and even Japanese yen is connected with US dollar. The quotes given are this way: INR/USD. Now how would you interpret this? Generally it is always given as USD/INR from the viewpoint of the proper presented quotes, but I told you, you are facing ICAI examinations, and here look at the right hand side over here. This is rupees 62.22. that means this is not the quote of Indian rupee, this is the quote of US dollar. Similarly over here it is Japanese yen 102.34. that means this is quote of USD in terms of Japanese yen. So I am going to interpret these rates as INR per US dollar as rupees 62.22 and JPY per US dollar as JPY 102.34. So look at these two rates. We want the quote of JPY in terms of INR, and that quote has to be arrived at through these cross currency calculations, where USD will be a common currency, and you know how to do that cross currency calculation. Now further given in the question, it is estimated that Japanese yen will depreciate to 124 level, means what we find currently JPY per USD as 102.34, it will become 124, and Indian rupee to depreciate against US dollar to rupees 65. So what we are finding in spot as 62.22 is expected to become 65. So basically what is happening, USD value is appreciating from 62.22 to 65, means Indian rupee is depreciating. Japanese yen is also depreciating against USD. That means both the currencies, Indian rupee as well as Japanese yen, are depreciating against USD. But we are going to connect INR and JPY because that will be relevant. So again, what we will have to do, using these two expected rates, we will be working out a cross currency calculation for expected rate of INR and JPY. Now further given forward rates for August 2014 were INR per USD 66.50 and JPY per USD is given as 110.35. Calculate the expected loss if hedging is not done. How the position will change if the firm takes forward cover. If spot rates on August 31, 2014 are INR per USD 66.25 and JPY per USD 110.85, is the decision to take the forward cover justified? Now carefully observe what exactly you have to do in this particular question. First of all, the question is given from the viewpoint of an Indian exporter and the invoice value is in Japanese yen 10 million or Japanese yen 1 crore. So this Indian exporter is going to receive this amount on 31st of August 2014. What all rates they have given? Spot rate first of all. Secondly, it is expected rate on 31st August, that is company's expectation of what would be the rate on 31st August. Then the quoted forward rate, and finally they have given the actual spot rate on the settlement date, that is on 31st August. So you know what you have to do basically, you have to arrive at what would be your profit or loss if you take the forward cover, what would be your profit or loss if you do not take the forward cover. So I already told you one thing, you have to be careful about the whole solution because first of all, INR JPY quote is not directly given. Quotes are given for USD in terms of INR and JPY. You have to apply cross currency calculations at all the 4 stages, and let me repeat those 4 stages. First one was the given spot rate on top. Second one was your expectation of what would be the rate prevailing on 31st August. Third was the forward rate quoted by the bank, and fourth was the actual spot rate on 31st August. So as I told you, your approach over here will be, first you have to decide whether you should take forward cover or not. So you look into what would be your profit loss position if you do not take the forward cover, and what will be your profit loss position if you take the forward cover. In either case, when you are receiving that inflow of Japanese yen 1 crore, what will be a better off situation? For that purpose, consider the invoice value at the spot rate, that means amount receivable as per spot rate and amount receivable as per your expectation of the future rate. Difference between these two could be your gain or loss without taking forward cover. Then once again make that kind of working by taking the amount receivable as per spot rate and then work out the amount receivable as per the forward rate. That difference will be gain or loss as per the forward cover. That means if forward cover is taken. Between the two, whichever is giving you a beneficiary situation, you just opt for that. So taking a forward cover or not taking a forward cover, you have to first decide that. Now suppose you end up taking the forward cover, then you have to even justify at the end whether taking that forward cover was right or not, and for that purpose they have given you the spot rate on 31st August, the actual spot rate on 31st August. So I believe I have made things very clear to you. You just have to now properly present the solution, and let me show you how to present that part of the solution. So friends, in the solution what you would do is first find the cross rate for INR per JPY, that will be INR per USD into USD per JPY. So INR per JPY spot will be INR per USD spot, which is given as 62.22 into USD per JPY. Now you know one thing very well,
The quote given to you was JPY per USD. If you have to multiply USD per JPY, it will be inverse, correct? And so what we finally get is 62.22 divided by 102.34. Friends, I am not going to take my calculator and compute this calculation. It is very simple. I would apply this as it is so that I do not have any rounding of error. Now, INR per JPY as expected in August. Now they have given that expected rupee dollar rate will be 65 and yen dollar rate will be 124. So it will be 65 by 124, and INR per JPY forward rate for August, which is quoted by bank already, it will be 66.50 divided by 110.35. So friends, before I take you ahead, please take note of all these cross currency calculations. Alright friends, you would have taken note of all these calculations. Let us move ahead and present the solution further. Expected loss if forward cover is not taken. Spot invoice value yen 1 crore will be multiplied to the spot rate of rupee yen, and that will be rupees 60,79,734. This will be the receivable in our hand, correct? Don't forget that we are exporters in this case. This is the amount receivable as per the invoice value. Now what is the expected value in August? If we are not taking the forward cover, what we have as expectation of rate during August, that will be 65 by 124 multiplied to 1 crore yen would give you 52,41,935 rupees. When you see you have more amount receivable as per the invoice value and expected value of receipt will be lower than the invoice value. As a result, you will find a loss that is expected 8,37,799. So we have computed this loss, expected loss, if the forward cover is not taken. So please take note of this and then we move ahead. Alright friends, you would have finished writing this whole thing. We would make one more calculation like this, but the heading will now be written as if the forward cover is taken. What will happen that the spot invoice value will remain same. Instead of taking the expected value in August, we will be taking the receivable as per the forward contract instead. So let us make that calculation also. What we get? Expected loss if forward cover is taken. Spot invoice value will remain same, that will not change, and this time receivable as per forward contract will be rupees 60,26,280. Expected loss substantially reduces to 53,454. Looking at this, we would obviously conclude that taking forward cover is beneficial. Anyway, do one thing, write up this whole calculation and then we move ahead. Alright friends, you would have finished writing this also. Let us move ahead and write up the conclusion up to this part, that is expected loss can be reduced if the forward cover is taken. Therefore, it is advisable forward cover should be taken. After writing up this conclusion, you have already planned to take the forward cover. Now you would want to look into whether taking the forward cover was even justified. So INR per JPY spot rate for August, this is the actual rate, correct? And we have again taken the cross multiplication, that is cross currency calculation, and we get the actual rate as 66.25 divided by 110.85. So friends, now time for you to take note of this as well and then we move ahead. Alright friends, let us move ahead and take up the last part where we say actual loss if forward cover was not taken. Spot invoice value will still remain same, but this time what we will do for settlement, we would take the actual rate. So receivable as per the actual rate will be, using that rate of 66.25 divided by 110.85, we get 59,76,545. The actual loss is 1,03,189, whereas the loss was substantially lower if the forward cover was taken. So we would indeed say at the end that taking forward cover was justified. But before that, please take note of this much. Alright friends, let us move ahead and write up the conclusion. Loss can be reduced if forward cover is taken. Therefore, taking forward cover was definitely justified. Write up this also.
Alright friends, once you have completed this solution, let us move ahead and take up the next question, that is question 5b. Again a question from Forex chapter, and in your textbook it is question number 49. Let us deal with this.
You have following quotes from Bank A and Bank B. Now Bank A has given you first of all quote of US dollar in terms of CHF. Same quote is given by Bank B also. Then Bank A has further given quote of pound in terms of dollar. Same thing Bank B also has given. Definitely the rates are different, but format is same. Look into one thing, 3 months and 6 month swap points or forward points are quoted by Bank A, clearly indicating that Bank A is also willing to enter into forward contracts. Bank B on the other side does not quote any forward points or swap points. As a result, Bank B appears to deal only at spot rates. The question is asking you to calculate two things. Number one, how much CHF, that is how much minimum CHF amount you have to pay for 1 million GBP spot. That means the objective is to buy 1 million GBP, and in exchange what you have in your pocket to pay is CHF. What does that mean? That you need to establish a rate between GBP and CHF. What we find in the question, quote of dollar given in terms of CHF and quote of pound given in terms of dollar. That means pound and CHF are not found to be directly connected. So obviously cross currency calculation will have to be applied. But now what we have to do is we have to look into minimum CHF amount that we have to pay. So between Bank A and B, we will select the rates whichever is the most reasonable, that is the cheaper rate available between quotes given by Bank A and Bank B. And that will be the answer for first part. Second part says, considering the quotes from Bank A only for CHF per GBP, what are the implied swap points for spot over 3 months? So we will deal with the second part only in reference to Bank A, but that we will discuss later. Let us first solve the first part. First part is very simple. You just have to apply the cross currency calculation. So what we do is first we write up the given spot rates of Bank A and Bank B. Okay, quickly note down these spot rates and then we will go ahead. Alright friends, let us move ahead and make the cross currency calculation. So cross rate for CHF per GBP will be CHF per USD into USD per GBP. For purchasing 1 million GBP, the applicable ask rate shall be. So what we have to do is we have to take the ask rate because we want to buy GBP, and you know one thing, for making cross currency calculation, if you are computing ask rate, the both calculations over here must be based on the ask rate. That means CHF per USD ask rate should be multiplied to USD per GBP ask rate. And now we have a choice. We would take the ask rate which is most preferred rate, that is the lower of the rates quoted by Bank A and Bank B. So if you look into CHF per USD quoted by Bank A is cheaper than Bank B. So this part of the quote we have taken from Bank A. That means CHF USD conversion we will be doing through bank A, and then USD GBP, a better rate is quoted by bank B. So USD to GBP conversion we will be making through bank B. So this cross rate is basically CHF per USD into USD per GBP, one taken from bank A, another taken from bank B. And finally, the lowest possible ask rate for £1 will be CHF 2.5866. Buying 1 million, total outflow will be CHF 25,86,600. So do one thing, note down this will be the answer for the first part, and then we move ahead. Alright friends, you would have finished writing this. In order to deal with the second part of the question, let me first show the question again on the screen. And so here it is, the question right in front of you once again. So let us read the second part. Considering the quotes from bank A only for CHF per GBP, what are the implied swap points for spot over 3 months? So you first of all have to consider the quotes from bank A only. That means bank B information is irrelevant for dealing with second part. Secondly, they are asking the swap points for spot over 3 months. So the 6-month information what we have is completely irrelevant. So what we do now is, we will take the spot rate and 3-month forward points. Now based on what we have learnt, look into the forward point information. It is for a two-way quote and it is given as a 5/10. That means numerator is smaller than the denominator. That means it is a case of premium. What we would say, dollar is appreciating against CHF. On the other side, you see for quote of pound in terms of dollar, we have the swap points as 25/20. The numerator is greater than the denominator. That means it is implied that the pound is depreciating against US dollar. So with this, let us put up the solution ahead and see how to present the solution. In the solution, we would first mention the fact that observing the swap points, it is interpreted that dollar is appreciating against CHF and pound is depreciating against dollar. Therefore, the spot and 3-month forward rates quoted by bank A shall be as follows. So what we do is, we first of all rewrite the spot rate over here, and the swap points for 3-month forward quoted by bank A were 5/10. As I told you, it is a case of premium. So 5 and 10 points will be added to bid and ask. Because it is premium, you would add. So the last two digits are 50 over here and 55 over here. Add 5 points to 50 and add 10 points to 55. So what you get as 50 plus 5 is 55 and 55 plus 10 is 65. So we finally got 3-month forward rate quoted by bank A with respect to dollar in terms of CHF. Now we write the spot rate of pound in terms of dollar, and the forward points for this quote are given as 25/20. 25/20 indicates a case of discount. If it is a case of discount, the swap points or forward points should be subtracted from this spot rate to arrive at the forward rate. So 25 subtracted from 45 and 20 subtracted from 60, what you get is pound 1 equals to $1.7620 to $1.7640 as a 3-month forward rate. So friends, what I want you to do, write down this whole thing and then we move ahead in the solution. Alright friends, let us move ahead and make the further calculations. So cross rate for CHF per GBP, you know it will be CHF per USD into USD per GBP. Now we have to calculate 4 rates: spot bid, spot ask, 3-month forward bid and 3-month forward ask. So we already have the quotes available. Spot bid will be bid into bid, correct? So CHF per USD spot bid into USD per GBP spot bid. Because it is bid rate calculation, you will multiply bid rate with bid rate, and obviously both will be spot. So spot bid, likewise spot ask. Spot ask rate will be computed by taking CHF per USD ask rate into USD per GBP ask rate. You know one thing, that when you have to compute ask rate, you will always multiply ask rate with ask rate. Exactly same way, you would also work out 3-month forward bid and 3-month forward ask. When you do this, you now have comparison possible. This is a spot bid and this is 3-month forward bid. Compare these two and look into the swap points. Last two digits 50 and over here it is 22. That means swap points for bid will be 28. Okay, and you identify likewise this rate, that is spot ask with 3-month forward ask. Compare these two and what you would find, 81 and 69. The swap point for ask will be difference between 81 and 69, which is 12. So bid swap points 28 and ask swap points as 12. So your swap points indicated in numerator denominator format will be 28 by 12. If it is 28 by 12, where numerator is greater than denominator, you would find that the quoted currency is depreciating. Let us check and see. Look into spot bid 5850, 5822. It is definitely depreciating. 5881, 5869. It is depreciating. So friends, please take note of this whole thing, and that will be end of the solution.
Alright friends, once you have completed this solution, let us move ahead and take up the next question, that is question 5C. Again a question picked up from Forex topic, and that is question number 91 as per your textbook. Let us deal with this. Suppose you are a banker and one of your export customer has booked a $1 lakh forward sale contract for 2 months with you at the rate of rupees 62.5200, and simultaneously you covered yourself in the interbank market at rupees 62.5900. However, on due date after 2 months, your customer comes to you and requests for cancellation of the contract and also requests for extension of the contract by 1 month. On this date, the quotation for US dollar in the market was as follows: spot rupees 62.6800 to 62.7200, 1 month forward rupees 62.6400 to rupees 62.7400. Determine the extension charges payable by the customer assuming exchange margin of 0.10% on buying as well as selling, and rates rounded off to 4 decimal in multiples of 0.0025. Now friends, again in this question there is nothing new. At the due date, the customer is approaching for cancellation and extension. So what you will do is, from customer's viewpoint, you will work out the cancellation rate, and because the customer over here is an exporter and customer has agreed to sell 1 lakh US dollar, for cancellation you will have a need to buy spot US dollar. So the spot ask rate will be relevant over here, but this being an interbank rate, for arriving at the cancellation rate for the customer, the margin will have to be added, and then because the customer wants 1 month forward, so you take 1 month forward bid rate, which is again an interbank rate. From this interbank rate, subtract the margin to arrive at the forward rate to be quoted to the customer for the purpose of extension. So let us look into how to present the solution over here. In your solution, first go for cancellation. First, the original contract shall be cancelled as follows: rupee per dollar interbank spot ask rate was given as rupees 62.7200. Add margin, and when you get that margin added, the rate is rupees 62.7827, and as per the requirements in the question, the rates will be rounded off to 4 places after decimal in multiples of 0.0025. So the nearest rate what we get as per rounding off application, it will be rupees 62.7825. Now customer sells US dollar at rupees 62.52 and for cancellation customer buys at 62.7825. So the loss to the customer, which will be the cancellation cost payable by customer, that will be rupee 0.2625 per dollar, and that will be multiplied to the quantity of 1 lakh US dollar. So the total cancellation charges will be rupees 26,250. So please write up this whole thing and then I take you ahead. Alright friends, once you have completed writing this much, let us move ahead and find out the new rate for rebooking. So for rebooking, being an exporter, you will consider interbank 1 month forward rupee per dollar bid rate, and that was given as rupees 62.6400. From that you subtract the margin at 0.1%, and the new applicable rate what you get is rupees 62.5774, which will be rounded off in multiples of 0.0025. The nearest value comes to rupees 62.5775. So please write up this whole thing and that will be end of the solution. Alright friends, once you have completed this solution, let us move ahead and take up the last question, that is question 5D. And again this is a question picked up from Forex topic, question number 67 from the book, and here we discuss this question.
DEF Limited has imported goods to the extent of US dollar 1 crore. The payment terms are 60 days interest free credit. For additional credit of 30 days, interest at the rate of 7.75% per annum will be charged. The banker of DEF Limited has offered a 60 days loan at the rate of 19.5% per annum. Their quote for foreign exchange rate is as follows. Spot rate INR per US dollar is rupees 62.50. 60 days forward rate is given as rupees 63.15 and 90 days forward rate is given as rupees 63.45. Which of the following options would be better? Pay supplier on 60th day and avail a bank loan for 30 days, or avail the supplier's offer of 90 days credit? So friends, what do we find in this question again? You will need 90 days to settle the payment. You have two clear alternatives. Pay the supplier on the 60th day itself by arranging local borrowings for 30 days, or take the supplier's offer for 90 days credit. So it is exactly similar question to what we have done earlier. Let us see how to present the solution. In the solution, you begin with alternative 1 first. There is pay supplier on 60th day and avail bank loan for 30 days. So as we have discussed, you start with the invoice value of $1 crore, apply 60 days forward rate, and what you get is amount payable after 60 days, that is by borrowing locally for 30 days. Now what you get is 63 crores 15 lakh rupees. Now on this your bank is going to charge interest at 19.5% per annum for 30 days, and that comes to interest of rupees 1 crore 2,61,875. So total amount payable after 90 days will be 64 crores 17,61,875. So take note of this and then we move ahead. Alright friends, you would have finished writing this. Let us go ahead and deal with the second alternative. So second alternative is to use supplier's offer of 90 days credit, that is 60 days free credit and 30 days extended credit with interest at the rate of 7.75% per annum. So what we have done, we have taken 1 crore of invoice value, that is $1 crore, right? and we have applied interest calculation on the dollar value itself. So what we get, amount payable after 90 days, it is still appearing in dollars, that is 1,64,583.33 dollars. And because this is the amount payable after 90 days, we will be considering 90 days forward rate of rupees 63.45 per dollar, and what we get as total amount payable after 90 days in rupee value, it will be 63 crores 85 lakh 97,812. So friends, what I want you to do is note down this whole thing, and then we move ahead for the conclusion. Alright friends, let us move ahead and compare the outflows under the two alternatives. And what do we observe finally? We would see that amount now saved under alternative 2 will be the difference between the outflow under alternative 1 and alternative 2. Amount saved under alternative 2 this time will be rupees 31,64,063. So we conclude that alternative 2 is better. Note down this as well, and that will be end of the solution.